Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engine so that more folks can also discover and engage with all things microcap stocks. Registration is now open for our next event, the Planet MicroCap Showcase, taking place in Las Vegas at the Horseshoe Hotel and Casino, formerly Bally's, on April 25 through 27, 2023. Expect 3 days of networking, company presentations, one-on-one meetings, in short, a lot of fun. If you follow our community and especially invest in microcap stocks, you're not going to want to miss this. We have many more announcements. I know I've been promising them, but very, very shortly, we'll be announcing our initial speakers and sponsors for the event, as well as a preliminary list of companies that will be presenting as well. So be sure to register to get all those updates and also to attend. So the website to do that is www.planetmicrocapshowcase.com. See you in Vegas. Now, for today's show, I invited back on Yaron Naymark, founder and portfolio manager at One Main Capital. Last time I had Yaron on the show, it was in July 2022, chatting about the first half 2022 microcap bloodbath, which of course we all know got worse. The Planet MicroCap Index was down approximately 40% for the year. Awesome. I've had a few investors on here to start 2023 where we dissected 2022, what worked, what didn't. And while Yaron and I start off the conversation that way, the reason I always enjoy having him on the show is that he has a unique ability to simplify. I just have to ask one question on what happened in 2022, and I think Yaron covers that question as succinctly and clearly as anyone, and in 15 minutes or less. So we chat about 2022, recognizing mistakes, improving his process, his 2023 outlook, and a short back and forth about morality with investing. Thank you again for tuning in to the Planet MicroCap podcast, and please enjoy my conversation with Yaron Naymark. This episode is brought to you by Stream by AlphaSense. You can find them at streamrg.co/PMC. That's STREAMRG.co/PMC. Stream is an expert interview transcript library that is starting to become an integral part to investors' research process. They have a number of interviews on a wide variety of companies, including TMT, consumers, industrials, real estate, and more. Stream provides over 300 expert interviews per week, and 70% of their experts are found exclusively on Stream. Stream is unlike any other transcript libraries. Stream integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Stream's community of experts and thought leaders partner with Stream to build their professional brands and expand their industry influence. Right now, there are approximately 8,500 plus call transcripts available. For more information, please visit www.streamrg.co/PMC. That's STREAMRG.co/PMC. Yaron, thank you for joining me.
Thanks for having me on again.
It's great to have you back. So the main reason I wanted to invite you on here today, we were going back and forth on scheduling and stuff, so it's been a few weeks since you put this out, but put out your Q4 2022 letter, kind of reflecting a little bit on 2022, now going into 2023. I've done a couple pods a little bit talking about this, but wanted to get your unique perspective on thinking back, looking ahead, even where we're at right now, a couple months into 2023. It feels like it's gone by like this. But, so let's start there, reflecting on 2022 and then we'll go from there.
Yeah, 2022 was a crazy period in markets where, we started the year and everyone thought inflation was transitory. And then at some point throughout the year, everyone freaked out and decided it was not transitory, including the Fed. The Fed decided that they needed to hike interest rates, short-term interest rates, which is what they really control. The Fed funds rate a ton. It was almost 0% coming out of the pandemic. And, it's now in the fours, approaching the fives. And it was a really rapid period that they took rates up from, basically 0 to 5%. And the steepness of that increase, and by the way, the long end also increased, the long end of the curve, not just the short end of the curve, as inflation expectations, increased, kind of longer term inflation expectations. Still pretty tame in the context of historical levels, but definitely, increased a lot throughout the year, early on in the year. And that freaked out owners of all risk assets. Obviously, bond holders, when they own bonds that are yielding very low levels, and yields have to go up through a combination of higher rates and wider credit spreads. That's really bad for bonds. So bonds were down a lot last year. Equities also were down a lot last year, partially because the risk-free rate went up. So the cost of capital for both debt and equities went up, partially because people were convinced that the Fed was raising rates so fast that they were going to crash the economy. And that's obviously bad for earnings. So you had a combination of rates going up, discount rates going up, bad for risk assets, expectations of a recession and economic slowdown, which is bad for equities. And so equities obviously perform very poorly as well. The interesting thing is, so far this year, CPI has started to roll. The Fed has started talking about slowing down the rate of their interest rate hikes. And it seems like risk assets, in particular equities, more so than bonds, have celebrated that slowing of inflation and increasing rates. And the fact that the economy seems to have held in much better than anyone would have expected if you would have told them we were taking rates from 0 to 5% over like 7 months. Everyone at the end of last year, mid last year, was talking about an early 2023 recession. Now it seems like people think we're not going to get a recession until at least 2024. If we get one, the consumers continue to spend, or they continue to have jobs. There's not a lot of unemployed people. The unemployment rate's not spiking. The economy seems to be really, really, really healthy given the magnitude of the increases. And so now, if you want to be bearish, you have to paint the case that inflation is going to reaccelerate, and it has not been solved. And if inflation reaccelerates, they're going to have to hike rates even further, which is inevitably going to crash the economy and risk assets down the line. And so the bearish narrative is kind of more from, 5% is going to crash the economy to 5% is not enough to even slow the economy a tiny bit. And so we're going to have to take the Fed funds rate even higher, and that's going to eventually crash the economy. I don't have a particularly strong view one way or the other. I do still believe we're working through the kinks of inflation. COVID threw a lot of wrenches in everything, and I just think it takes a long time to work it all out. One of the things that I am optimistic about is that even though there's a lot of job openings, the number of employed people continues to increase at a nice clip in the U.S. Specifically. And at least we're seeing a a supply response to higher wages, right? There's demand for more employees. Wages are going up, and it's not like wages are going up, but we're not finding more employees. Wages are going up, and that's encouraging more people to come back into the labor force. And so it's going to take some time to work its way through and for us to see what the eventual result is of all this stuff. But I still think I'm optimistic that inflation will eventually be transitory, that the economy will be strong. And even if we go into a recession, my view is that this is not 2008. There's not a ton of, it might be in sovereign sector, right? Public sector. I don't think private sector is as leveraged, not consumers, not businesses. They have clean balance sheets. They're in really good shape. And so if we go into a recession, I don't think there's going to be these forced liquidations of people's houses and businesses, which is obviously really bad for the economy and employment and valuation multiples. It's bad for everything. I just don't see that being, the base case recession. A base case recession is we have some negative GDP quarters, unemployment, kind of increases a little bit, but doesn't spike the way it did in 2008. And I think, companies will survive. Consumers will not have to give their houses back to the banks. And the reality is, if you want to own risk assets, you have to believe that the Fed will do whatever it takes to crush inflation, even if it means putting us into a recession. So a recession is not that scary. What's scary is them not doing what it takes to crush inflation, because if inflation becomes really, really sticky and we get 8%, inflation forever, then, the bar for owning equities in that environment is extremely high, because risk-free rates will be 8 or 9 or 10 or 11 or 12%. And earnings have a very hard time growing, and free cash flow has a hard time growing in that type of inflationary environment. So equities are long duration assets. The short-term interest rates shouldn't really have that much of an impact on them, other than near-term earnings, but definitely not long-term multiples. What should have an impact on long-term multiples is long-term inflation expectations, and us absorbing a near-term recession to keep long-term inflation in check is exactly what you would want to happen if you're an owner of long-duration assets. So I'm optimistic. There's a lot of really cheap names out there. A lot of babies were thrown out with the bathwater last year. I've been able to reposition the portfolio into names that I think will navigate this coming particular recession, better than an average company in the economy. But valuations are really attractive. I'm optimistic, and I'll leave it there and see if there's anything else you want me to touch on.
I mean, there's a lot to unpack there, but let's touch on how, we're recording this on Friday, Feb 17. So most of earnings are pretty much over. There's still some hanging out there, some calls coming up in the next couple of weeks. So, I mean, from some of the calls that you've heard, what have been management teams signaling on an individual company basis when you consider all of these macroeconomic pressures?
Yeah,
I guess.
I mean, the economy is staying really strong. It sounds like, inflation, I think, has become less of a topic, but it's definitely still, it might not be front and center, but it's still a front, just not in the center. Capital markets were effectively shut down for the back half or the fourth quarter of last year. They're starting to reopen a little bit. Companies are refinancing their debt. They're pushing out maturities, which is positive on the margin. Consumers, remain confident, and their spending is resilient. And yeah, I think the narrative for recession has definitely been pushed out, which is why you've seen equities rally here at the start of the year. Now, there's always going to be a bear case, right? Like, until we make it through some kind of recession, there will be a bear case. But I think, there's lots of equities that are priced to deliver really good results, even if that bear case plays out, as long as it's not way, way, way worse than, a normal recession.
Yeah.
And if we don't get a recession, some of them will do even better, obviously. And so I think it's our job to find those securities. I think I've assembled a portfolio that I'm really pumped about for the next few years.
For sure. So, going back to your Q4 letter that you put out, in one section you talk about recognizing mistakes and then improving the process. On the point on recognizing mistakes, I mean, I feel like sometimes people might, or some investors are hard on themselves, where it's like, okay, the timing might have just been bad. This company, I think, is higher quality. It might be high quality, or at a minimum, it's quality. Maybe there's some hair, but it's at least quality. It's worth taking a shot right now. All these different macroeconomic pressures happen. And then, of course, there's just a massive sell-off probably in the stock.
Yeah.
How do you balance this idea of recognizing the mistake in proper company valuation or just looking at the fundamentals and understanding the business versus like, you know what, it was just bad timing?
Yeah, I mean, bad timing.
Do you say bad timing is a mistake? I don't know. That's one of those things that I go back and forth in my mind when I think about.
Yeah, our job is to get everything right, including timing. Right? If you want to produce Hall of Fame results for 20 or 30 or 40 years, which is what I want to do, you have to be a Hall of Famer, and that means having a well-rounded game, right? You can't just be good at three-pointers and not at assists and rebounds and steals and blocks, and you gotta improve everywhere at all times, and timing is a part of that.
I don't know. You should look at Duncan Robinson's career, man. Like that guy still made 55 million over 5. But anyway, sorry, bad joke.
No, but I mean, look, generating good IRRs isn't just generating, turning $1 into $5. It's turning $1 into $5 over a reasonable period of time. If you give me $1 and give me an infinite amount of time to turn it into $5, I could do that with treasuries. Is that me being a good investor? No. So I think timing matters because IRRs matter to investors. It's not just the multiple of capital you're able to return to them, but how quickly you're able to return to them. And then you could reinvest that into other stuff that's going to compound. So timing definitely matters. Every idea in the portfolio and on my watch list competes for a spot on the court every single day. And if a position gets benched, it was usually because it was a mistake to have been put on in hindsight. Now that mistake could be not a process mistake. That could just be, our job is to pick good risk adjusted, to pick good bets at the moment that we pick them with all available information we have available to us. And sometimes, that information changes and it makes positions less attractive. I think you can't just look at the outcome of every investment and say, this one I made money on, it was not a mistake, and this one I lost money on, it was a mistake. But there are, situations where you could look back and objectively say, I might have been overly optimistic, even based on all available information I had at the time. And our job is to, avoid those again, making those same mistakes again in the future. I think there are tons of managers who got caught up in, higher valuation, higher growth names and had their whole portfolios in them. And it was very easy to extrapolate COVID winners. I had one COVID winner that I thought could buck the trend. And it turns out I was overly optimistic on them bucking the trend. In hindsight, maybe the bar should have been higher from putting it into the portfolio. I thought, if they buck the trend, which adds an extra level of complexity to an investment, right? If and there's something called a COVID headwind, right? The COVID beneficiaries, there's an added headwind. Maybe your cost of capital for that position should be higher. And thankfully, it was one position in my portfolio. It wasn't that big, but it cost us a few hundred basis points last year. That sucks. And it's something I don't want to repeat. But I think if you keep your mistakes small and you recognize them and you avoid repeating them, I think that's all part of the process of getting better. I think I've known this for a long time, but when you have a wider range of outcomes, potential range of outcomes for an investment, you should have a higher hurdle rate. And a 3-year double is exciting for me for most of my investments, but if I think the range of outcomes is extra wide, I should be demanding more than a 3-year double. I should be looking for a 3-year triple or a 4X. And so that's kind of how I kind of formalized it into the process. I knew it, but I didn't have a formal kind of rule for it. And now I do. And it's all part of making the process better. Every day, every year, I think the first podcast I did with you, I think I read you a Kobe Bryant quote where he's just, he gets into the gym a few hours earlier every day than someone. And by year 10, it really doesn't matter how much work someone's doing. They can't catch up because it compounds, that type of improvement compounds on itself. And that's my goal, is to keep compounding my small improvements. And, I've been running my fund for 5 years now. I was an analyst at other funds before that, and I worked in private equity. But really, being a portfolio manager is I think where you are able to improve at a pace that is much harder to do when you're an analyst. And so I'm 5 years into being a portfolio manager. I think my game has improved a ton since day one. I think it will continue to improve for the next 5-10 years, and I'm hopeful I can, I'm proud of the performance I've had, 5 years, 20-ish% net of fees, in an environment where the Russell has basically been flat over that 5-year period. I'm proud of it, but I think I could do better and for longer. And that's the goal.
So what would you say has been your biggest improvement? Let's just say year over year from 2022, beginning of 2022 to now.
Yeah, I mean, I don't think I'm making step change improvements anymore. I think I'm making marginal improvements. So there's not like one thing where I'm like, at the start of 2022, I lacked this skill and now I have this skill. I think, the new rule that I've implemented for myself for a wider range of outcome investments, just kind of formalizing the higher hurdle rate that I'll be looking for, I think is definitely a process improvement. From 2018 to today, I've definitely, in the later years, have paid much more attention to management alignment with me. Even if it means, sacrificing a little bit on valuation. And when I mean sacrificing on value, when I say sacrificing on valuation, I don't mean buying things at 40 times earnings or 30 times earnings. I mean, instead of buying something at 8 times cash flow, if I could buy something at 12 times cash flow, but with more alignment and a better management team, I'll do the 12 all day. So that's another thing I've changed about my process. I'm just much more focused on clean balance sheets. And if there's not, I've always been focused on clean balance sheets, but like if there's not a clean balance sheet, similar to the wider range of outcomes on the business, it's a wider range of outcomes on the equity of the business because it might be more leverage. I should be looking for a 3-bagger, right? Over 3 years, not a double over 3 years. So, I just think there's lots of small improvements I've made over time. I think there's probably more improvements to make over time, and hopefully I can keep making them.
Absolutely. So another topic I wanted to talk with you about today, and this is something I've been thinking about it a lot since I would say 2020 when we did a bit more ESG panels and talking about impact investing and how that kind of has tried to kind of seep into the investing communities, and it has. I don't want to say that it tried, it failed. It definitely has. But I think about this a lot also when I'm interviewing various companies, because we cover everything here at Planet MicroCap, from mining to whatever. So I think it's a bigger conversation around this ESG with impact, and it really comes down in my head to this idea of investing morally. And I'm curious from your perspective, how do you think about that in terms of where do morals come in when you start thinking about like, all right, man, this is a clear home run right here, but they're in an industry maybe that I'm not a big fan of or a consumer in or something like that.
I mean, look, ESG, and in particular E&S, so environmental, social governance, is becoming more front and center, and it's going to have an impact on valuations more and more of companies. So you have to pay attention to it if you want to be a good investor over time, because ETFs are moving that way, mutual funds are moving that way, long only funds, they're focusing on it more and more. Sadly, it's more on the E and the S, and a lot less on the G is kind of my impression of it. And I think E&S are really important. Environmental and social are really important. Governance should also be really important, but it seems like that's kind of taken the back seat. In terms of there's still a lot of sleepy boards with not a lot of skin in the game, not aligned with shareholders who make decisions that might not be in the best interest of shareholders either, because they lack sophistication or they just don't care. And so that's a bummer. I think for that part of my process, it's on me to find boards and management teams that care about shareholders and that act in the best interest of shareholders. In terms of environmental and social and ethics and all that stuff, I think if you want to invest in businesses like you could invest in trading sardines, right? You could be trying to buy 50-cent dollars and hope that eventually they'll trade for $1. And if that's what you're doing, if you're investing in a trading sardine or a quick catalyst driven business that's, stock that's just going to re-rate for some reason, there's forced selling or there's a spinoff or, there's an event, then you probably don't need to care about it as much because there's an event. It's just a trade for you. It's not an investment. But if you are going to make an investment in a business, meaning I'm owning this business for 3 years, 5 years, 10 years, hopefully for a very long period of time, I think it's very important that the E and the S are, right. Because if they're not, it's destabilizing to a business long term. Because if you're not treating, the E and the S with the respect they deserve, the government and your employees and your customers will eventually revolt and force that upon you. If you're destroying the environment for too long and you get too big and successful, I guarantee you the government is coming after you. If you're treating your employees like crap or your customers like crap, your employees will eventually quit, they'll unionize, your customers will eventually find a competitor and they'll move their business over, right? Your shareholders could choose to leave as well. So or banks could stop lending you money. So I think if you disregard environmental, moral, social issues, you are risking your business long term. And so it's not even that it's a good thing to do. It's a smart thing to do for your shareholders, for your pocketbook, because I think having a stable long-term business is one of the most important things. If the stock market closed tomorrow and you had to own your portfolio forever, you would definitely not want a business that's taking advantage aggressively of its customers, of its suppliers. And so, from an ethical standpoint, I typically think is everyone winning in these transactions or is someone getting abused? And, if everyone's winning, customers, suppliers, then I think, including the environment, by the way, right? Because if you're destroying the environment, not everyone's winning because society is losing, right? And same with, so that's kind of my view. I think you want stable businesses and that means having responsible E and S and G, hopefully, but people focus on that less.
So let me ask you this, let's talk about maybe the perfect scenario of, let's say we're talking about a company that E, S, and G, all three, let's say they're top notch, above 90th percentile amongst their peers. They're knocking it out of the park. They're not low environmental impact, really quality in terms of social, whatever that can mean, right? Let's say their governance is top notch. They have an active board, quality board. They're all personally invested, that kind of thing. But it's still a company that, you then have to then question of all right, this happens to be in a sector or they're in a space that I'm not quite sure about. How do you think about that? Even though it might be a home run.
What are we talking? Coal, gun stocks?
Yeah, the whole bit. Yeah.
I mean, coal is,
not coal. Coal, that's clearly an environmental disaster.
Fine.
But let's say guns, let's say strip clubs, let's say that a whole bit. And by the way, this is no judgment if you are investing in those, by all means, it's just something that I've been thinking about quite a bit. Yeah. And I know you've looked at a couple of those too.
Yeah. I mean, guns, customers obviously love them. Suppliers, no problem. Employees, no problem. Shareholders, no problem. Society, question mark, right? We live in a society where, probably half of society thinks there's no issue with gun ownership and the other half thinks there's an issue with gun ownership. And I think if it's just an open-ended question of gun ownership or not, it's probably 50-50. But if it's a question of responsible gun ownership, it's probably 80% of the country wants responsible gun ownership. And then the question is, what does that mean? How responsible is responsible? And I can assure you that at some point in 1 year, 3 years, 5 years, 10 years, 15 years, 20 years, 30 years, the government will put their hand into this issue and come to a conclusion on your behalf. And so I think, that warrants a lower valuation. You have to get your cash out more quickly to get paid for that uncertainty. And I'm not going to make a statement on, what I think about gun ownership, but as an investor into that stock, I just think you need to take into account that there's an external force that might get applied to your business. Same with healthcare, by the way, drug companies, right? That aggressively price for the drugs. If you're an investor in that company, I've heard these pitches where it's like they have all this pricing power because if people don't take that med, they're going to die and they have to take that med. But like, if you're thinking about that purely from like an economical, like near term, like they have pricing power, they have customers that can't go anywhere, they have patents, that sounds amazing. But if you think about it from like a long-term perspective, that sounds potentially destabilizing. As far as RCI, I personally think everyone's winning. Like the only employees are happy, no one's forcing them to work there. Customers are happy, no one's forcing them to go there. Shareholders are happy, no one's forcing them to own the stock. Now, there might be people out there who think those customers and employees are amoral and they should be stopped because what they're doing is amoral, even though I don't have to go there and I just don't want anyone else to be able to go there. And yeah, if a big enough portion of society thought that, you would have to start, and if this company got big enough, you would have to start thinking about that. I think we're very far away from that them being big enough and in the headlines enough and a big enough part of society thinking about that. And by the way, these things are regulated on a local level, and they happen to be in states that are very friendly, towards that type of business environment, Texas and Florida specifically. And so, like, I think it's a calculated decision you make on every investment. If you don't have a moral issue with it yourself, and you don't think there's going to be a destabilizing force, then I think it's fair game.
Absolutely. Yeah. And that's why I'm happy I brought this up with you, because I feel like whenever we talk, we both kind of see that there is both sides to this argument, but it's been coming up a lot recently in some of the companies that I've invited to come on our due diligence series that I've been wanting to learn a little bit more about their businesses and whatnot, where, on one hand, I'm not going to interject my own personal opinion on any of these areas, but the part that has been I've been thinking about a bit more is the equivalency of, the clear cut, like strip clubs, guns, these like particularly hot topic amoral issues, versus what some of these other industries and how they've affected shareholder base. I mean, anybody who's invested in crypto, cannabis, biotech, pre-commercialization, I mean, they've gotten just as taken to the cleaners as if maybe you would pour timing on some of these other sectors, or, had you invest in these other sectors, if you're taking your morality out of it, you might actually done well as an investor versus, putting your money in some of these other things.
Yeah, look, investing it's not just about winning for me. It's about having fun along the way. And so it's kind of an art, people who've done it for a long time, well beyond when they're very wealthy, which, like, I don't care how much money you gave me tomorrow, I would still want to have a Hall of Fame track record for 20 or 30 or 40 years. And so, like, if you want to do something for a long time and it's your art, it's not just your job, you want to have fun along the way. And that means doing something you feel pumped about. So, like, yeah, if you find an investment that you think you can make a lot of money on that might be amoral in your eyes, like, the world's not starved for interesting and good investment opportunities. I come across thousands and thousands of companies that I could research and do work on and spend my time on. So, like, I don't know. I mean, you can kind of self-select what works for you as an investor also. If someone else wants to invest in something that I don't like the concept, let them do it. I don't have a particular, but I think they should take into account that if just because they have no problem with it doesn't mean society. They should have a view on what they think and what society thinks, and what the likelihood is that society then imposes its will on that business, regardless of what they think, because that's how the world works. We live in a democracy, and the government can interject and say they don't like what you're doing. And obviously you need the will of the people and not just the politicians, but it's definitely a possibility. And so if that becomes a real risk on a probability weighted basis, you should be getting your cash out more quickly and getting compensated extra for taking that risk. That's kind of my view. I mean, I think you should just not given there's so many good investment opportunities, if you just spend time looking for them, I don't know why you would spend your time looking at things that you have a problem with that specific business.
Yep. No, I couldn't agree more with that. Like at the end of the day, like if you're questioning your own morality when you're looking at what seems to be a layup, there's another.
It takes the fun out of the game.
Yeah, there's like, and now you're going to be staying up at night. Like that should now factor into your criteria at some point. Like, all right, well, I'm not a gun guy, so even if this is a layup, like I should maybe there's another bus or not a canvas or whatever it is.
Yeah.
I couldn't agree more with that. So listen, let's close this out because I mean, it's such an interesting time because there's like so many things to talk about and yet not that much at this, I find myself, even as a podcaster here and thinking of different topics to cover, like there's some interesting things, but you may think something's interesting, but it's not even catching, so I mean, for you, what's been the most interesting thing that you've seen thus far in 2023 that you think might have some legs for the rest of the year that other folks might gain some more popularity?
Yeah, I don't know. That's a good question. I mean, clearly there's, some flashes of early 2021 meme craze, that kind of retail back in full force, buying zero data expiry calls and, buying meme stocks. There's definitely some flashes of that, which is not what you would want to see, driving the market higher. And then you also have bears who just continue to pound the table and shift the narrative on like what's going to take stocks lower. I'm kind of a keep it simple, find interesting opportunities kind of guy. And I think there's lots of interesting opportunities out there that do not involve memes and do not involve businesses that are overvalued and highly exposed to a shallow recession. And so that's what I'm spending my time doing. I'm optimistic that, that's going to be rewarded in 2023, 24, 25. I think, nothing is ever as good or as bad as it seems. I forget who said the quote, but like, it's very true. And like the world is not a static place. It's a dynamic place and humans react to information. And so like, right when rates are zero and everyone's like, inflation's going to get really bad, no one gets it. And then inflation starts to get bad, people increase rates. The Fed increases rates, bondholders demand higher compensation for bonds, credit spreads blow out, and that has an impact on the real world. So like, I just think anyone who wants to say we're going to the moon or we're going to zero, like it's just rare that the world operates like that. You've had financial crises where it seemed like every bank was going to go under unless the government stepped in. You've had the COVID where it seemed like every human on earth might die unless we found a vaccine or if the virus wasn't as bad as we feared. Thankfully, that happened. We found a vaccine and the virus wasn't as bad as we feared. But so you have these existential moments that obviously are very, very risky and what could happen to risk assets and to society as a whole if they play out. But in general, like an average recession is not something to be that afraid of as an investor. If you are thoughtful, you pick good businesses, strong balance sheets, predictable business models. They can play offense in periods of economic uncertainty and market volatility. They can make accretive acquisitions. They can go after market share while their competitors are, retreating. And they can create a lot of value long term. So I think fixed income is definitely more interesting now than it's been in a really long time. Like, hey, you could make 5% in government bonds, 1 year government bonds. That sounds, if you don't know what else to do with your cash, that sounds like a pretty sweet option. But I think there are things out there in equity land priced to deliver much higher returns that have more inflation protection if inflation does continue to be at high levels. And that's what I'm spending my time looking for. So
there we go. I think that's a great place to end it. Yaron, where can everybody go and find more information and follow you on social media?
One Main Capital is my Twitter handle. And then that will direct you to my website or my email address. And I'm pretty responsive. So please get in touch there.
And Yaron, real quick, are you a shareholder in RCI? You mentioned that earlier.
Yes.
That's good. Yaron, always a pleasure, man. Thank you so much for joining me. Really do appreciate it. Good luck. Stay safe. And I'll catch you around here soon.
Thanks, man.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.